Look at the chart on your screen right now and focus on that massive vertical line sticking up from the top of the candle. It is not just a line. It is a crime scene where the price of silver flashed to $83.71 before collapsing to $74.47. This was a $9 swing in a single trading session that likely terrified new investors. But for veterans, it was a calculated algorithmic attack known as a stop hunt. The bank saw liquidity drying up during Ghost Week and let the price run to suck in retail money before slamming the door. This rug pull was engineered to hit the stop-loss zone at $75, triggering a cascade of thousands of sell orders that allowed banks to buy back positions at a massive discount. Technically, this candle is a shooting star, featuring a small body and a very long upper wick that represents rejection at the $83 level. While this typically signals a pause or buyer exhaustion, the trend remains bullish because we are still up nearly 10% from last Friday's close. Gold remains the anchor at $4,514, showing stability while silver acts like its high beta sibling. As long as gold holds $4,500, the floor under silver is secure. The reason the price fell so easily is that the order book was hollow, creating an air pocket that only filled when it hit the limit buy orders of industrial whales sitting at $75. The $75 level, which was old resistance, has now been validated as new support, proving that smart money like Samsung and Tesla wait for these smashes to scoop up cheap contracts. There is a massive disconnect right now because, while the paper market crashed, physical dealers did not lower their prices, and some even raised premiums. They treat physical metal as a stable store of value while viewing the paper price as a broken casino. If you were waiting for a $74 dip to buy physical, you likely missed it because that window was only open for minutes, proving this was a paper event, not a physical one. This $9 drop was actually a gift to industrial procurement managers who used the bank as manipulation to secure inventory at a discount. We are building a staircase where the steps are getting steeper, and the floor has moved from $65 last week to $74 this week. Volatility is essentially a tax on leverage, and while it wiped out those trading on margin, physical holders lost nothing because an ounce is still an ounce. This flash to $83 was a price discovery preview that showed us where the price wants to go once suppression lifts. The move was specific to silver's internal market structure and not a macro event, which is actually bullish for January, because it resets open interest and clears the decks for institutional capital. We should expect some sideways chop between $75 and $80 as the market digests this move and moving averages catch up. The stability in gold confirms that the monetary premium is still intact, and even on a crash day, silver is outperforming where it was just a week ago. As we approach the end of the year, there are 3 days of Ghost Week left where liquidity will remain thin, meaning we could see more flashes in either direction. Your job is to stay out of the crossfire by avoiding stop losses in the system that banks can easily target. If silver closes the month above $75, it will be the highest monthly close in history, sending a powerful signal to pension funds for 2026. While the shooting star candle might make algorithms cautious in the short term, long-term pension fund managers see this as a $5 per ounce discount relative to the high. The banks may have saved themselves for one day, but they have only increased the explosive potential of the next rally. To prepare for the final 48 hours of the trading year, you must audit your leverage. If today's swing made you ill, you are over-leveraged and should move toward physical metal or paid-for mining stocks. The $75 line is your line in the sand and remains a buying opportunity as long as it holds. Ignore the intraday noise and the weird candles caused by low volume, as the shooting star in this context is likely just a liquidity test rather than a reversal. The wick created today is not a ceiling. It is a target that the market will likely return to fill in early January once the new money arrives. You have endured the volatility and held the line, positioning yourself in an asset class that offers protection from debt collapse and exposure to the energy boom. Think of the silver price like a beach ball being held underwater. The bank's grip slipped for a moment, and the ball shot up to $83 before they wrestled it back down. But now we know exactly how much upward energy is stored in that ball. Alternatively, the current market trend is like a rising river. The banks can build a dam to pin the price down temporarily, but as the water continues to rise, the dam will eventually break under the pressure.